All right, what's up, everyone? We're going to talk about chapters 14 and 15, which will be our penultimate chapter lectures, to auditing the financing and investing process. This is part one. Part two, we will cover on the Wednesday, which you will hopefully have watched this lecture by then and know all the things that I'm talking about. But let's go ahead and talk a little bit about this. There's a lot of topics we're going to cover in very, very quick order. These are things that are not as critical as the items that we talked about in chapters 10 and 11. So we want to discuss them at a very high level, and we've even got some items that we do need to know some detail on, but are fairly straightforward and simplistic relative to some of the other things we've talked about. So one thing to remember is that when we cover the revenue process, we generally focused on information that was going to be in the income statement, but is affected by the current assets, by most of the current assets. So we've covered accounts receivable with respect to the revenue process. On the flip side, with the purchasing process, we've covered accounts payable. So we covered those current liabilities. We're already talked about inventory, which is another form of current assets. And we're going to talk about cash and investments on Wednesday. So basically, what's left to talk about today is everything else on the balance sheet, which sounds like a lot, but those are going to be minor details relative to the whole. So let's get started. First of all, prepaid expenses. Those are current assets that are expected to provide periodic benefits over the course of the year. You should have some familiarity with these already. Prepaid rent, which is something that I'm sure you're familiar with as Truman State students. You likely have your own prepaid rent that you've had to pay for this current month, if not this semester. Prepaid insurance, that's something that you're probably also familiar with, and paying the insurance in advance to cover any issues. This is particularly relevant with things like automotive insurance, or as you may experience later on in life, homeowners insurance. And then prepaid interest, which is something that's less profound, but still very relevant. Again, this is very largely relevant when we start talking about things like homeowners insurance. That's usually paid altogether in one payment with your mortgage payment, which includes the interest for the period. So prepaid interest can actually be relevant there too. Yeah, so that's an interesting way to think about that. And of course, there's a house just to reiterate those points. So, what are some aspects of prepaid expenses we need to be aware of as auditors? Well, we can say about inherent risk that it's low and just move on from that. There's not going to be a lot of risk associated with misstatement of prepaids. They're generally fairly small and they're fairly easy to understand. They're one of the very first things you learned about in accounting back in that financial accounting class that you took at the beginning of your college careers. Then what about control risk? Well, control risk assessment focuses on whether prepaid expenses are properly authorized and whether they're recorded. Okay. So two aspects of the segregation of duties, which we've talked about. Um, it's important to note that prepaids are part of the purchasing process, so segregation duties would involve the functions that are in the purchasing process. But you may be asking, why do we not include some discussion of custody here? And the answer is pretty straightforward. Think about whether custody of prepaid assets actually takes place. When you pay for the rent, you pay for the insurance, you pay the interest, you have put that in the hands of somebody else who will basically use that asset when it's consumed. Who will basically consume that asset over the life of that use. So it's going to eventually convert into an expense. So prepaid rent becomes rent expense, prepaid interest becomes interest expense, prepaid insurance becomes insurance expense, so on and so forth. And you don't actually have custody of those assets. And moreover, you can't gain custody of the assets. Imagine that you just all of a sudden said, I'm done with Truman State. Dr. Barnes has ruined education for me. I'm leaving. All right. So you go to your landlord and say, I paid for the month of November, but I'm leaving now. Can I please get my rent back? They probably would say no if they didn't just laugh at you and mock you in some way. So custody is not going to be a very big consideration with respect to prepaid expenses. It's just not practical to consider yourself with. Now, that being said, analytical procedures can be fairly helpful. They can be very effective in respect to how we can actually evaluate prepaid expenses. We want to look at trends over previous years and ratio comparisons relative to sales or assets, which is pretty self-explanatory. We've talked about all of those with respect to all of the process areas we've discussed so far. But at some points, we can actually compute estimates based on terms of prepaids. So if we know the value of the prepaids and we know the duration that the prepaids are supposed to be used over, it's pretty easy to develop an estimate of what expenses associated with prepaids should be, and even what the balances of those prepaid amounts are. All right. So real quick, let's just go ahead and go through some assertions relative to audit procedures. We want to confirm the policy with the insurance broker. This one's a little bit dicey. I didn't put in the full language here, but this would be making sure that the insurance broker, this is making sure that the policy beneficiary who actually can receive the proceeds of the insurance policy. That would be more about rights and obligations. Now, if we confirm policy of the insurance broker and examine supporting source documents, then that goes a little bit more in depth. That's where we're talking about the directional testing, and that can actually be both existence, occurrence, and completeness. With respect to determining the an expired portion of prepaid expense, that sounds like a lot like a mathy stuff. So that's going to be VAA, valuation allocation accuracy. And then determine the propriety of distribution between manufacturing overhead and SG&A expenses. So this is very specific to certain prepaids with respect to how we're going to actually classify those according to whether they need to be capitalized or whether they need to be expensed when incurred. That being said, you've heard the word that I just said, it's classified, so it's going to be a classification issue. All right, so moving on, prepaid expenses will generally be a very, very small area. As the previous slide said, they're generally going to be very minor, often immaterial, so they won't be a big focus of audit testing. Something that will be a heavy focus of audit testing, though, are going to be property, plant, and equipment. These are general material and generally very important. So for new engagements, we want to verify that all assets make up the balance of PP&E. In other words, we want to look at every single asset, and we will have to conduct some level of testing for most of those, which is a lot of work. That being said, we do have kind of a shortcut that we can use for recurring engagements, and then we're going to focus on additions and disposals to property, plant, equipment using a fixed asset roll forward. Now, what is the difference? Okay, what does that mean? Let's just go ahead and put it in context of how this course works versus my other course, my other undergraduate course, the Accounting 367. So when I teach Accounting 367, most of the students that are in that class, I have not met before. I do not know their names or their faces. And so I have to learn those at the beginning. I have to learn every single one of their names and faces to start. So I have to basically learn all of them in order, and have to basically to figure out who is who, what their names are, and what's going on. So it's basically starting like a new engagement. I have to learn everybody's name from the beginning and who they are, and just get acclimated to them from the beginning. Now, Accounting 417 is a little bit more like a recurring engagement. Most of the students that I've had in Accounting 417, I've had in a class before. In fact, in this class, I've had every single one of the students in 367 that I had them in 417 in a previous class. So I don't have to worry too much about relearning the names of the faces. All I have to do is learn the names and faces of new students, if any. So that's going to be the example of a recurring engagement. And we talk about this item called a fixed asset roll forward. What does that mean? Basically, it means that we're going to focus on changes. We're going to focus on changes in what the balances are. So when we look at assets, where we're trying to audit this amount here, right here, what the ending balances are, what the ending items are, we know that the beginning balances were audited in a previous period, hopefully by us if we were the previous auditors, and we have some assurance that these amounts are materially correct, okay? So if we are trying to validate this information and we know this information is correct, all we have to do is audit this information in the middle. If we determine added additions and disposals, and transfers are minor, but they could take someplace, but usually focusing on just additions and disposals, then if we determine that these numbers are correct, then we've validated this ending balance by virtue of the fact that we know the beginning balance was correct. Makes things much easier. Instead of testing everything every single period, we only test the changes. We only just test the additions and disposals. So there are four basic categories of PP&E transactions. We talked about acquisitions, which are going to be our additions, and then categories of disposals, which are going to be sale, exchange, retirement, or abandonment. We also have that thing called depreciation, which we know is going to be the usage of those assets over time, except for land, because land doesn't get depreciated. And then we also have to include the leasing, because keep in mind that leasing is one of those critical attributes that we do now have to keep on the balance sheet. Now, since authorization and custody of PP&E are contained in function of other processes, usually PP&E cycle is concerned solely with the recording, which again makes sense if we're considering that this is just about validating the balance of these items. We're just going to be concerned about the transactions that represent changes in the balance. All right. So with respect to inherent risk, our assessment depends on the complexity of transactions and valuation of fixed assets. Now, that doesn't give a lot of guidance, but I want to put a pin in that because I want to talk a little bit more about that when we get to long-term debt. It becomes a lot more apparent once we get into that area. With respect to control risk, we do want to verify the proper documentation of acquisitions and disposals, ensure that identification and security of fixed assets in this place, and review written policies for capitalization and depreciation related to fixed assets. That's generally it. There may be some other concerns about controls, but for the most part, this is very minor. Now, here leads to an interesting point. I did not talk about which strategy we were using, but let's think about what I said earlier. For the most part, we're going to be testing the individual transactions, which implies that we're not going to focus as much as on controls. And this control risk tells you that we're only focusing on a few really important controls. What does that mean? It means that in all likelihood, we will be using a substantive strategy rather than a reliance strategy. All right, let me get prepared. All right, so we finally reached substantive strategy. When we're going to actually use a substantive strategy, what better way to celebrate with a little ray gun dancing? Here we go.
Old Australian stockman lying, dying.
All right, that's probably enough. That's probably enough. Sometimes we gotta take this thing in pieces. Yeah, we may come back to that. But oops, I stopped sharing. Oh, there we go. Hi. All right, I'm going to share again and get back to where we were at. My apologies. Okay. All right. I just thought that would be a fun way to celebrate our introduction to substance strategy, a little bit of ray gun dancing. I heard she retired, which is kind of sad. The world is losing a little bit today because of that, but yeah, it is what it is. We've got to move on. So property, plant, equipment, as we're talking about, we can actually use a substantive strategy instead of a reliance strategy where we focus on testing the transactions rather than focusing heavily on testing controls. This is going to be one of those rare situations. We'll get into a little bit more detail about the philosophy of that here in just a little bit. Um, so with respect to analytical procedures, they can be very effective in audit testing, especially as they relate to accounts such as depreciation, maintenance, and assurance. Now, think about why that might be the case. And the answer would be is that these are generally functional calculations based on what the balance and the associated PP&E accounts are. So can we develop an expectation for what depreciation is based on the value of a particular asset? The answer is yes, assuming we have all the necessary information, such as the useful life of the asset, the depreciation method, and the residual value. Same for maintenance and insurance. We can develop very good models for developing expectations in this area. So we can use our trend analysis, we can use our ratio analysis, but this is a prime area where utilizing model analysis or reasonableness analysis will be very helpful to us. All right, moving forward, let's talk about some audit procedures and some assertions here. So with respect to property, plant, equipment, want to review PP&E purchases dispositions before and after year end for recording proper period. Should know this by now. When you see before and after period end, we're talking about a cutoff testing. Want to recompute depreciation expenses for reasonableness. That's a recomputation, which only tests a single assertion. That's VAA. We're going to vouch a sample of PP&E purchase to the receiver report and vendor invoices. And assuming that I use vouch correctly, which I almost always do, but I did in this particular situation, so this is existence occurrence. I want to examine a sample of significant changes to repairs and maintenance expense for items that should have been capitalized. So we talked about capitalization earlier. Basically, we're turning whether account should or a particular transaction should be one account versus another account. That's be an asset account versus an expense account. That's an example of classification. All right. That was good. Let's go ahead and do some account balance testing now. Obtain the fixed asset schedule and agree totals to the general ledger. Yeah, see, we weren't agreed. We probably should be VAA, but the simple truth is we're going to use VAA a little bit later. This one's not well explained, but this is completeness. Recalculate accumulated depreciation reasonableness. This is our VAA test because recalculation, again, is a test of VAA. Perform a physical inspection of fixed assets, test for unrecorded retirements. That's going to be existence occurrence. Now, this is kind of confusing because we see unrecorded retirements and we say, oh, unrecorded items, that's got to be completeness. But when we're talking about unrecorded retirements, we're talking about items that should no longer be in the balance sheet or in the financial statements that still are there, okay? So the retirement should have taken place and did not get taken place. So the item does not exist, but the records say that it does, all right? So that's a little bit confusing the way the wording works, but this is not something that should have been recorded, that shouldn't be recorded. It's something that should have been removed is effectively the way unrecorded retirement reads. And examining invoice deeds and title documents to convert ownership of fixed assets, that one's easy. That one's going to be rights and obligations. All right. So we're off the balance sheet. Let's move over to, or turn off the balance sheet. We're off the assets. Let's move over to the other side of the balance sheet. Let's talk about some liabilities. So long-term debt comprises all debt instruments and potential hybrid instruments with resolution periods longer than 1 year. So what is it that we're auditing? Well, we're going to audit the debt instruments themselves and the associated interest expense. What type of debt instruments can we be talking about? So long-term debt, there's only got to be one or two of them, right? So like notes and bonds and debentures, certificates, mortgages, leases, anything else that might be a debt instrument. Yeah, there's a lot of possibilities here, which leads to some interesting conclusions that we're going to talk a little bit about. So what about inherent risk? Okay, let's go ahead and consider inherent risk with the following concerns. Okay, from size, these are going to be generally very large. All right. But activity in these area accounts are going to be minimal. Most organizations do not have a lot of long-term debt transactions. If they're going to be very, very large transactions when they take place, but they're not going to be transactions that occur frequently. What about complexity? The answer is, as with any accounting question, it depends. All right. So when we talk about just notes payable and bonds payable, those are not complex at all. But what about hybrid instruments? Instruments that have both characteristics of debt and equity? How do you value those? The answer is it's really, really challenging and very subjective. Generally, it leads to some very complex calculations, which require the use of a specialist. So it depends on the nature of debt. If the debt is straightforward, then we can talk about complexity being very, very low. But if the debt is not straightforward, then it may be very challenging. So we're going to work on a sliding rule and say inherent risk is going to be very heavily contingent on the complexity of the associated instruments. Now, long-term debt, possible auditors tend to use a substantive strategy for testing long-term debt. Okay, and I'm not going to bring Reagan back up. Okay, just imagine her dancing in your head, a little bit like that. Yeah, yeah, we're back to a substantive strategy, and the question is why we're going to be utilizing a substantive strategy. Now, we need to consider the activity from the prior slide and also our discussion from long-term assets just a little while ago. What do all these have in common? And the answer is that it's generally more efficient to audit a small number of transactions than the controls surrounding them. Even if we're only talking a few number of controls, control testing usually involves a lot of analysis. If we just test the transactions, though, if there's just a minimal number of transactions, then we don't really need to test the controls. So for long-term assets, for long-term debt, oftentimes we will rely heavily on a substantive strategy for testing because we can test just the transactions themselves. That being said, when test controls are necessary, especially if we're talking about long-term debt being controls being relevant to reporting, and we know that we have to test internal controls that relate to financial reporting, ICOFR, we usually focus on authorization recording related to long-term debt, okay? Because custody is really irrelevant. It doesn't matter who has custody of those items. Long-term debt is usually the stated owner of the debt and the stated issuer of the debt. All right. As far as substantive analytical procedures go, they're not terribly relevant for the testing of long-term debt itself, but very useful for testing of interest expense, which is something we've already done. If you recall from Chapter 5, we actually had slides on this that talked about the detailed testing. Remember, we talked about the line of credit that was at a bank and it was based on the monthly balance, and the monthly balance generated the interest expense. If we knew what the monthly balance was and the average rate of interest over the period, we could generate an expectation. And that's what we did. That's all there is to it. And that's what many organizations do when testing interest expense. They can do that for any expenses associated with debt or anything associated with the liabilities and equity side that has a predictable trend. All right. Moving on to audit procedures. Examine copies of new note or bond agreements. Examine the board of directors minutes for approval of lending agreements. All right. So this one probably not sufficient by itself. But one thing we're very concerned about is we want to make sure that the items that have been recorded, we can actually identify that they pertain to the organization, which would be an existence occurrence test. Review the date of activity of simple days or for a few days before and after year-end, determine the transactions are included in the proper period. That's obvious. That's a cutoff test. Test a sample of receipts and payments. I apologize. That probably should be a lot more detailed, but we are going to be testing for valuation, allocation, accuracy. Trace large cash receipts and payments to source documents to the general ledger and evaluate lease contracts to determine if leases are properly accounted for as an operating or capital lease. Interestingly enough, the first part of this is going to be completeness, which is what I've got. the last part probably should be edited out because if we're talking about operating or capital lease, that would be a classification issue. So this is actually two assertions in there. And again, something I should probably correct in my slides and yet still forget to do on a semester to semester basis. And then examine the due dates and notes of audit or bond for proper classification between current and long-term debt. That's obvious. We use the word, it's classification right there. All right, so those are tested transactions and events. Let's talk about how we would test the account balances. Want to examine the copies of note and bond agreements. Doesn't really tell us what we're examining for, but usually when we talk about this, we're talking about, is this an obligation the entity has to meet, which would be rights and obligations. Want to examine the new debt agreements to verify they're recorded at proper value and verify the proper computation of the premium or amortization of the premium or discount, which you should be familiar with that with debt, how to amortize the premium or discount with respect to the value. We're not going to do it in this course, but it's important to know that that was something that's included as part of the valuation process. So valuation, allocation, accuracy. We also want to obtain a standard bank confirmation requesting specific information on notes from banks and confirm notes with bonds or creditors. In general, we're going to be more focused on completeness in this regard, but keep in mind when we talk about confirmations for this type, they can test multiple assertions. Our two primary assertions in this area are going to be completeness and existence occurrence. All right, now we have stockholders' equity. Stockholders' equity, auditors are going to be generally concerned with three types of transactions in this area. It's going to be the issuance of stock, which would include sales or exchanges, conversion, which is example that would be convertible debt, when you have a bond that can be converted into shares of stock. And then stock splits, which is not really an issuance of stock, but it makes people feel like it's an issuance of stock. Then we have the repurchase of stock. Repurchase of stock is basically going to be through reacquisition, the issuance of, or they call it, classify it as treasury stock, or the retirement of stock altogether. And then payment of dividends, which has its own unique concerns with respect to cash dividends and stock dividends. Stock dividends are very much like stock split. They don't actually pay anything out. They just make people feel better. All right. So the guidelines we discussed for long-term debt also apply here. Specifically, when we talk about inherent risk, it really depends on the complexity of the equity instrument. Remember, our example for debt on the complexity side was whether or not it was a hybrid instrument. If it's a hybrid instrument, it could either be debt or equity. So we could have convertible bonds, we could have convertible equity items. We could have elements that are instruments that have elements of both. It's really, really hard to provide proper valuation and proper treatment if we do not know specifically what it is. Again, very high subjectivity. So inherent risk is going to depend on the complexity of the associated instrument. And control risk, substantive strategy preferred. Again, the reason for that is going to be consistent with long-term debt. Generally, there are not going to be a lot of equity transactions in most organizations, so it's just easier to test those individual transactions themselves than the associated controls. That being said, true segregation of duties is very important in this area. We want to make sure all three aspects are maintained because equity is a little bit more volatile than debt and with the regard. So we want to make sure that custody, authorization, and reporting, all of these are going to be maintained. Now, we're going to talk a little bit more about testing of investments themselves directly when we have an ownership interest in another organization. That will come in Chapter 16, but we'll talk a little bit more about the items that should be segregated here and now. So when possible, the following duties should be segregated. Individuals responsible for issuing, transferring, canceling stock certificates should not have any accounting responsibilities. So we're talking about an authorization function being segregated from a recording function. Individual responsible for the detailed stockholders record should be independent of maintenance of general ledger control accounts. These are kind of redundant functions, but that occur with recording at different areas in the organization, which we've seen already. This is not really segregation of duties, but more still a separation of responsibilities that are redundant to one another. The individual responsible for maintaining the detailed stockholders record should also process cash receipts or disbursements, so recording and custody. And the appropriate segregation duties should be established among the preparation, recording, signing, and mailing of dividends check. That's all three: custody, authorization, and recording. Now, when it's not possible to segregate due to personnel shortage, compensating management abuse controls should be in place. This is probably a statement I should have made in a previous chapter, maybe with respect to payroll or inventory when we talk about subsidiary functions. Whenever we see segregation of duties that should be in place, but that cannot be even put in place practically speaking due to personnel constraints, it's important for the supervisory officers in that area to make sure they understand that segregation of duties does not exist and promote proper review of procedures on a regular basis. If we want to go back to an example of this, the good example was the Dixon, Illinois fraud that occurred. And we talked about that. I think it was all the way back in chapter 6 when we were talking about controls. And so remember, we talked about that incident. That was the scenario where the financial controller for Dixon, Illinois, had responsibilities of all areas, and there was literally no review of her work. There was really literally no review of the things that she was doing, and so she was able to basically do bank drafts to her own bank account without bank drafts to her own personal account without any oversight or supervision or review of that responsibility. So segregation of duties, if we know that it's not existent, we need to make sure that there's supervisor review of that, at least on a regular basis, and that the auditors follow up and make sure that review is taking place. All right. So we're going to talk about all tests of categories here. So we're going to talk about both transactions, events, and account balances all together. So confirm the stock transfer agent the number of shares authorized, issued, and outstanding. All right. Confirmation can actually test multiple assertions, but our primary assertion with stockholders' equity is definitely going to be completeness. So that's the one we list here. Recompute the value assigned to stock transactions during the period. We have a recomputation test that's definitely going to be VAA. Want to vouch transactions recorded to current period board minutes. So if we're vouching, then we're testing from top to bottom. We're moving up about top to bottom, which is going to be our existence test. And determine whether there are any restrictions on retained earnings. Okay, so this is basically if we concern ourselves with retained earnings, sometimes we may have restricted retained earnings, which means that it cannot be used for payment of dividends. It must maintain a certain balance and cannot go below that balance, which if you remember, when you pay out retained earnings, that's a liquidation of retained earnings, basically. If restricted, then that's going to be a different category of retained earnings that cannot be used for that purpose. So if it's a different category, we're talking about classification. Now, really quick, let's talk about dividends, because we didn't really go into detail about dividends, and it's a really important area. Because of concerns of violations of corporate bylaws or debt covenants, all dividends declared and paid should be audited. So this is not even, we could have controls in this area, but we would still audit every single dividend payment transaction, dividend disbursement and payment transaction. Now, this is an interesting question because I often ask questions on this area on an exam and students get really flustered on this. So I do want to make sure that we're clear on what's happening here. It's not important to understand the procedures that are being done, but we should have some reasonable level of understanding of what we're concerned about as auditors in this area. So let's talk about when an independent dividend dispersing agent is used. If that's the case, we want to actually reach out to that third party, which we know that reaching out to a third party, any communication like that is going to be a confirmation. So that's a communication with a third party request. And we're going to agree the amount with the amount authorized by the board of directors. Now, before we move on, let's just talk about what it is we're trying to find evidence for. For a confirmation, we can actually have multiple assertions, but our primary assertion in the confirmation, since this is an equity item, is definitely going to be completeness. We're going to make sure that all dividend transactions are recorded as they should be, okay? And then the other one we're going to be concerned about, we know so the agree the amount with the amount authorized. That is a mathematical calculation, which means that we're concerning ourselves with valuation, allocation, accuracy. So confirmation of information and agreeing the amount to the board of directors, testing for completeness and valuation of allocation and accuracy for these dividend amounts. All right. Now hold on to that. I want to look at the next one. What if an independent agent is not used? That means that the organization we're auditing, they authorize and disperse their own dividends. So if that's the case, we need to make sure we recompute the amount of the dividend authorized by the board of directors. That's a test of valuation, allocation, accuracy, and trace the amount to cash disbursements or dividends payable. So tracing would imply that we look at see what was the amount or what is the amount that was actually paid out, okay, the disbursements and the payables that were generated, and go and see if what's in the system. So we're moving from bottom to top, which is tracing, which is a test of completeness, okay. Ultimately speaking, regardless of what method we use, whether we use a confirmation and agreement method or we use a recomputation and tracing method, we're trying to test the exact same two assertions in this area: completeness and valuation, allocation, accuracy. So keep that in mind. This has always caused confusion in the past. It shouldn't be that confusing because we know that that's going to be a critical area for understanding with respect to dividends. All right, last thing we need to talk about is we need to talk about auditing the income statement. Now, recall from our discussions, when we talk about balance sheet accounts, we usually talk about how to test them directly. I just talked a little bit about how we tested fixed assets or property, plant, equipment, long-term debt, and equity and associated dividends with those. So we're talking about direct test of those, and we'll continue to do so in chapter 16. Now, when we discuss income statement accounts, we usually test them as we talk about them how are tested as part of another account or process. So an example of this would be interest expense. When I talked about interest expense, it was tested as part of long-term debt. So what does this imply? And the answer to this is quite simply is that most auditing takes place through the balance sheet. Now, in the book, they actually refer to this. They say that the income statement accounts are usually associated with balance sheet accounts that are audited. And it makes sense because if you think about this, most income statement accounts cannot be affected in isolation. When we have a transaction that affects the balance sheet, it can actually affect the income statement, but it's just as likely that you could have a balance sheet isolated transaction. So an example would be if you have a collection of a cash on accounts receivable, you would debit cash and you would credit your accounts receivable. On the other hand, if we have an account transaction that affects the income statement, it is almost most certainly going to be one that affects the balance sheet. There are a few rare exceptions where you have transactions that solely affect the income statement, but it's so uncommon for that to happen. Most transactions that affect the income statement also have a corresponding effect on the balance sheet. In other words, if we verify that balance sheet information is correct, we are, by virtue of testing the balance sheet accounts, also testing the income statement accounts and the transactions associated with that. So all of these balance sheet accounts tested, all of these items that are being tested, have a corresponding effect on the income statements that we're testing by virtue of testing the balance sheet accounts. Now, this does lead to some interesting discussion. So what if we have very big concerns about the income statement accounts directly? Most of the times that will be answered using analytical procedures, which are frequently used to obtain assurance about the income statement accounts, using trend and ratio analysis, and sometimes common size income statement for current period years, looking at trends. We can also look at key revenue expense accounts in some detail, but we usually verify the transactions by an account by verifying the supporting documentation, and more importantly, looking at their corresponding effect on the balance sheet. The isolation, and on isolation, all that this is saying is that when we talk about auditing the income statement, is usually subordinate to testing the balance sheet. We usually perform most of our auditing testing through the balance sheet, and that's been consistent for all the chapters we've talked about to date. We talk about auditing the balance sheet transactions of our assets, like long-term debt or equity, and will continue to be in place. That does not mean that the income statement accounts are not important, but usually they're going to be we're going to be able to provide some assurance by virtue of our test in those process areas that are associated to the balance sheet accounts that they hit. All right, well, that does it. Thanks for sticking with me, and thanks for enjoying the dance, and I will see you in class on Wednesday.